Good people, how are you? It's the Market Sniper. Yes, good to be back talking on traditional markets. In fact, I'm going to talk about a number of very interesting things today. First of all, debt. Many of you, this blows over. I'm going to explain to you why it's important. The debt markets yields are climbing, and they are climbing at a percentage basis level that is more significant than most people realize. In short, you are seeing the devaluation of the debt market and an increase in yield. We're going to also do a check-in. Remember, we said gold and silver we felt would more likely face a deflationary strike. So far, that's been broadly inaccurate, and the market has moved up. We'll do a check-in take on gold and silver with you. And where we are at on that. Silver was my primary trade, and we'll update you on that. So debt, and then we'll also take a look at ARK and what the market is highlighted for them. Is there going to be a deflationary strike, or is everything just back on the big groovy and everyone's still just in fear, and it's all just a little bit about Russia and Ukraine and all these other fake narratives that are being conjured to create concern, trepidation in the markets. Okay, let's deal with debt. First of all, people just need a basic understanding. Many of you don't have that, so I'm going to just give a very quick level one. In fact, we have a far more detailed link that I'll drop in the details below, by the way, on a podcast explaining debt. But in essence, a contract is issued at a certain point of time that commits to pay a certain interest rate that is the governing rate at the time if you're a government bond, and they get a block of money in return. So a pension fund gives them 10 billion, and they will say you can have it back in 10 years. That's a 10-year debt instrument, and we will pay 0.5%. if that was the interest rate at the time. So that would then be worked out, and they would pay that fixed amount every year in interest, and then at the end of the 10 years return the money. Usually all debt is being rolled because they still need the money, so they reissue it and ask for another 10 billion, pay back the original guys, and take out another block. Plus there's new debt being created all the time. This is why we are in a debt bubble. But what tends to happen is once people stop valuing those items, because they are traded in the second-hand market, so the person who bought it and was getting 0.5 yield, which on 10 billion, well, it's not particularly large amount. As the interest environment starts to change, and you can get today a new 10 billion paying you 2.04, that's that number over here on the US government rate. See it over here with me. That's the current market take. Why would you pay 10 billion for something that's going to pay you a quarter of that? You'll only pay a quarter of the amount. Can you see that small difference in percentage makes that 10 billion worth about 2.5 billion today? Because to get the same block of money in the contract that is being paid to you as an interest to measure up to the price you would get today. Remember, efficient markets, you can get 2.04 on a 10 billion block today. So you'll pay only 2.5. The amount that is being paid remains the same. So it's contractually written in. And that will then mean a 2.04% on the now 2.5 billion net worth of that debt. So as interest rates go higher, the value of the debts that was previously issued, that is trading in the secondary market, goes down. So you see devaluation, and it goes down. And you can see how small amounts, just the difference between 0.5 and 2, actually have a 4x potential difference in the value of that debt. So we are seeing debt devaluation at the moment, with rising rates. And if there's any bubble, that's been the debt bubble. And that has been very, very prevalent throughout our economic system. And I've speculated at great length that by keeping an unsustainable high value to our debt market, the canary in the gold mine that keeps calling time on it being absolutely a fake market is gold. That has to be kept down for debt to be kept up. So inherently, we are gold and silver bulls and wanting a sound money system. It's quite funny when we think Technically, we might feel that silver will get a sell-off to get called bankers' friends in the comments. So there's a lot of people that misunderstand. There's a difference between short-term assessing what the paper price of gold and silver might do in what is quite possibly a manipulated market versus being a supporter of the fiat monetary system, because you're seeing maybe a bit of weakness coming in for them. So we will be talking about that silver and gold, and we'll go back to it shortly. Anyway, we have called this breakout some time ago. In fact, in this debt game, we have been the earliest to, and I've referenced these big charts a number of times. We've been the earliest. Go see the previous debt market video that we did on YouTube, which highlighted when we first started talking about it with the COVID plunge in rates. This was a huge rush of money into debt because that was deemed a safe place. This, by the way, at the moment is yields. That's what's being paid. So it is the inverse to value. So when the rates absolutely dipped so low, bonds were incredibly worthwhile. Everyone was running to the fiat trade. So bonds were being bid up. Everyone was getting out of stock markets that were crashing, getting out of Bitcoin, getting out of risk on assets, getting into safe, watch the inverted fingers, markets of debt. And at that very low yield, at the spike lows, you're at about 0.33s, approximately on 10-year debt. That was the peak bull of valuation, in our opinion, in bonds. And we've since been highlighting what we feel is a structure of shouldering. Now, it's not perfectly aligned on the 10-year. It is on 20 years and others. Some traditional technical analysts would draw a declining neckline, for example, for an inverted head and shoulder, and we'd be drawing it. Well, HVF method just gets you in there a lot earlier. That's at the takeout of that point over there. And of course, by calling this a final capitulation in yields, we've been bullish, yields to the upside. And that is, of course, bearish, the value of the debt. And we've shown you this head and shoulder on the values, and we can show it again to you. But what this means is we're currently expecting a march through the 2.170 on our upside HVF. You can find out a whole bunch more about HVF methodology. Go to themarketsniper.com. It is not suitable for everybody. Book a call. Hit the link, book a call. Go to themarketsniper.com. Book a call, have a chat. It costs you nothing to have a chat, and you can find out a little bit more. And we do a full demo in the call of what the platform's like, what you get, the learning materials, the trading, the discussions, the chat rooms, the webinars that we do. We do countless webinars on an ongoing rolling basis. You can find out all about that. To do that, go book a call. Anyway, so the point is 2.17 is the top out before we have a rest. You're actually making quite quick progress. You had a little bit of what we call a wind up in the in-play area over there to boost you through the second, and it could be quite soon that you get through there. In other words, the time to target is very efficient, which is also a sign of strength to the yield side, and bearishness, of course, to the value as the asset class. So what actually happens in an environment where you're getting a deflating in value debt market? Well, other things, the money's running. The money's running out of debt and it's running into other things. And we suspect long run this will be the likes of gold and potentially other debt deflating instruments. However, if it first gets disorderly because of rate rises by the Fed on their fixed rates that they are setting for banks, what then ends up happening is you first could get deflation before you get all that money running into Bitcoin, gold, silver, etc. So whilst long term we think you end up with increasing values in all of those alternatives to the debt fiat system, you can first, in the process of closing the clamp and squeezing everybody's nuts, their eyes water and they wet the bed. And that comes in a shock collapse of the economy. Let's see stock market go down. Already in UK, the housing rates on a new bonds are in about 3.9. So the rate you borrow when you buy an asset like a house is significantly higher than the rates. In fact, the first Fed rate hasn't even hit. They're supposed to do one in March, hasn't even hit yet. This is just the talking about, and we're already seeing the yields rising. So people are backing out of the debt as an asset class. And we've called this the end of the 40-year cycle. Go check the previous YouTube. So let's move on to a different image and chart, because this is just a short-term move. Of course, if you have a head and shoulder here, there will be a far bigger move, which we have forecast and shown you in some of the other instruments. In fact, this is one that I was sharing on the Twitter feed. Are you following at the Market Sniper and at the Crypto Sniper? We do occasional short updates there. It's a lot easier. Doing a YouTube takes a lot more effort and a lot more time, but we do give quick update views. And of course, if you're in the community, that is where you get everything first in terms of what our thinking is, and in far greater detail. This is a left shoulder. Some have said, it's kind of a small left shoulder and it's kind of a big head. You get varying degrees of proportionality between heads and shoulders. This is actually a larger right shoulder. They've tried to keep the debt going. It looked like it wanted to roll over there, and then there was a little bit of a push into the debt. But this spill back down to this key level is a key point. What are we looking at here? So this is an ETF on the debt market. It is on the 20-year Treasury. That is American debt. All the instruments so far that we're looking at is American of nature. This is dominant. And by the way, the Europeans are facing the same, and in fact, so are the Japanese. And overall, debt deflation is going to cause more problems. It's going to cause immense problems for everybody, let's be frank. But there are slightly varying degrees of depthness of the sewage pipe you're climbing into here. And the dollar will probably be the net beneficiary in time as that occurs, in spite of it. So that's my opinion and take on that. So left shoulder, head as we've drawn it in TG Pink, and then of course your right that is spilling. And this is why we're updating you on this now, because on one of the biggest 20-year ETFs, you are now literally at the triggering moment after a very uncomfortable spill. And you can see in terms of value, there's quite a substantial value. Bonds are meant to be the boring, dull, stable, limping along like a 100-year-old tortoise crossing a road asset class. It's not for thrills and spills. It's the absolute converse of crypto. Equities were the exciting, the rah-rah, that which could move. Bonds were bringing stability, and a tortoise, a 110-year-old tortoise, I don't think I can be more accurate. That's how they were perceived and put out. However, you can see that that's not exactly turning out to be the case, because at the peak of this right shoulder, not so very long ago, you were probably at about 155 in valuation, and you are now at 135. Now, that's not mega crypto 2xing, 3xing in a week, and it's not even equity based 15-20% in that is sometimes possible in a handful of days, but it is quite a significant deval since round about, what date were we here? Let's give you the date. Let's grab him. Top of that right shoulder was 2nd of December. So you've gone from around 154-ish down to 135 by mid-February. Now, don't forget, the big element that's going to cause real pain and hardship here is the fact that pensions are very heavily stooped into government debt. So they were forced buyers almost by remit, because what they do is they issue an annuity, which is essentially how pension systems work, is they work on the basis you're going to need a stream of income until you die. They model the average number of people that are in existence and around, and they think they know how long you're going to live. You're going to live 5.6 years once you go on pension, or 8.9 years, and unfortunately that's increasing. Hence, it's kind of handy to have a little bit of a culling event for those financial systems, lest I get a little bit reset on you, or certainly let them pick up a bit of sickness, a little bit of cancer, a little bit of unsurprising heart weakness, for example. Those will help the actuaries immensely, because people's lifespans are extending, and these pensions are bust, and government debt is an absolutely garbage instrument. So they're devaluing at the moment. But when they devalue, they also pay a tiny bit more on the new debt that they're buying, and if that continues to devalue, they will continue to get higher yields on the basis of that new new debt. But that interest that they receive from government in terms of payments is what they then pay out their pension. So they give a lump sum to government, they get given it back in bits and pieces, and they use that to pay your pension, and then at some point you die, and they keep the rest of that capital for other people if they still have left over. However, if that capital is shrinking too fast, and they've invested an immense amount at very low yields, what happens is their capital base is reducing immensely. There is a major pension crisis coming, which is why reset will involve the cancellation of private pensions that have been bounced into government debt on a big scale. Almost certainly they will not be meeting their needs. They may also be chasing into crypto and much higher risk asset classes to try re-inflate their capital base if they think it's going to go up. They're going to need to be much better managers than they have been. But as I've already highlighted, a lot of that was compulsion. They had to. It was by government decree that the financial cartel that is banked by government was backing the debt system. So here we are, fine people. You are at the point where one of the most biggest ETFs is potentially at a macro reversal. We can show you this on a slightly bigger time frame as well. That's on a weekly. Let's see how much data we'll get. I'm not sure we'll get the full monthly on this. There's better ones with better history. That's 2 weeks. So every candle represents 2 weeks. This is what you've done. Down, 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 one up of a fortnight, down and down at the neckline. So since the commencement of the 6th of December, you've had 1, 2, 3, 4, 5 fortnights straight down with only 1 2-week period with a moderate pushback. That is pretty much hard selling. Don't forget, this was an inverted HVF, an absolute spiller. This was when post the COVID we said this was likely to roll over, and we called for the end of what has been the biggest bull market probably in history. 40 years since Volcker did semi-serious Federal Reserve policies. I'm going to throw in a wild card in here. I didn't mention it to you, but there's oil. Now, inflation is getting out of control. So this is really interesting. Inflation is getting out of control. And one of the reasons we felt there would be a little bit of a pullback on the gold and silver potentially first is that this number right here is knocking on the door of the 100, and that is very psychological. 100 is very psychological as a level for oil. So you're transitioning from 2 digits to 3, and that certainly warrants a key level of significance in terms of how we characterize them. You can learn a lot more about why we do that. But law of round numbers is a pretty simple one. I don't think there needs to be too much said on that for you to understand. And you've been squeezing higher. And let's also point out, since this spill over here, which also saw Bitcoin and a lot of risk on asset sell-off, you've had 1, 2, 3, 4, 5, 6, 7, 8, 9. You've had 9 upward weeks with 1 downward week, and this week is still in play. This week is still in play on a spinning top, squeezing higher. So the idea was, yep, we've had this phony war narrative that has been pushed to create a little bit of super fear. It seems the usual suspects are pumping that one, like CNN, etc. You've got this technical structure where you could be squeezing into a point where you might be needing a little bit of a pullback first. But long run, we have been bulls on this, and we remain bulls. Don't forget, we were the ones that called it down to single digits just prior to COVID 1984, and now we have pivoted to the long side, and this is the Rockefeller tax on doing stuff. What does this mean, and what's it got to do with bonds, and when will I bring in the gold and silver into all of this? We will be doing all of those things shortly. This is the purest feeder into all inflation. Everything is delivered, everything is driven around. Plastics have oil in it, packaging, everything has oil. Your freedom of movement, your travel, of course, very directly has oil. Your heating of your apartment through winter season, electricity, that your ongoing energies. And oil is a large part of that, as well as packaging. So this is a transaction tax. It is a movement tax. It is a living in a hot apartment, a warm apartment tax. It's a cooking tax. It is literally a cost on everything. And this has been going up immensely. And by the way, freight rates are going exceedingly high on moving oil. So shipping tankers are making big money, making exceptional amounts now. So they might have to sit in a place like Panama outside there and wait ages. Each day is salaries to the captain, all the staff, etc. It's $25,000 a day just to sit around and wait for your turn to be taken through the canal to go from the Pacific into the Atlantic, or from through Suez, etc. So this is costly monopoly bottlenecks. The Rockefellers love to own, and the clan of World Economic Forum, generational money, bioterrorists, etc., love to own monopolies. They are not capitalists. We are not experiencing capitalism. We're experiencing an oligarchical, corporatized monopolism, where a clan and a cult have essentially cornered pricing power. So anyway, this will go up, and this will mean more money to them, and it's going to push the inflation number up, which is going to further put pressure on the need to raise interest rates at the Fed level for the banks, which will have a trickle-through effect on your mortgage prices and everything else, and on the same debt instruments that we have been looking at, such as the US 10-year, the 20-year ETF, etc., etc., etc. So there is a real turning in. This is part of reset. And let's be clear, as I need to highlight a lot, is that as you have added debt, as the rates got lower and lower and lower, you started to cut your cloth thinner and thinner. The seams were getting smaller. The margin for stitching was getting less. You've gone from triple stitching to double stitching to a single stitch, and your cloth is cut so fine there's just enough room for a bit of stitching. Those fabric that of this system is really got little wiggle room and is as delicate as can be. And as you load up on debt, it's like putting your hand in the sweetie jar, as I sometimes say. The bigger the fist of sweets, the less likely you can pull out. So you've loaded up on that sweet debt in there. You can't come back out to the higher levels because you're carrying too much. It gets tighter and tighter as the neck goes up. And the fact that you could have been higher before was because you had less debt before. And as you went lower down and were loading up, you can't come back up. And that is kind of the situation. So the failure of the debt system comes significantly earlier than people realize, because we can't get to previous levels of interest rates that we've had before. I've often shown a chart that illustrates that rather well. And let's bring it back up again. I think it's the TNX and the TLT. This is the history of rates on a much bigger scale. What by having the log scale in here, what you'll appreciate is since the highs of rates, we've added debt non-stop. We've built a runaway debt system. And government has become the most spendthrift, and it doesn't matter whether it's Republican or Democrat. They just spend on different things, ridiculous projects, trillion development projects, on the F-35, you buy it for God knows how many billion a plane, etc., and you have a lemon for a product. And of course, the military-industrial complex makes out like bandits. So this final broadening structure, boom, spiller, thriller, absolute dip in the rates on the 10-year, and now you're rocking. And that's classic of end of trend. So we've covered this in the other YouTube, so I don't want to go too overboard in recapping that. Go and watch the other. So what does this mean for gold and silver? So, and our call, which has gone against us largely. So here was our call. Our call on gold and silver ranked the following. So first of all, I was trading silver, but I was observing gold because it's a key role player. And for us, we are asking the question, was this an up or a downside break? The metals has had a long period of pullback since then. And as I say, we are sound money fans. But just a question of, will we get a deflationary hit first before we get to run away? This debt tightening is going to absolutely destroy the market, apart from killing pensions, apart from making everybody's cost of living. I mean, let's be frank, people will spend less. So stimulus is pulled. This is not a stimulus. You don't tighten and do stimulus. They are going to, at a government level, do that, but they're not sending stimulus to the end user and end consumer. So those people are going to cease to get funds to help them anymore. The generosity spell is over. It's you caused the inflation. You went and bought second-hand cars and drove the prices up, and now there's not enough chips and all that nonsense, which is largely government-led, the creation of 7 trillion in the States, the Triffin's dilemma to proliferate dollars because there was a shortage of dollars globally, and giving it to the Kennedy organization for the Democrats and all the other specialist quangos. Very little of it actually as a percentage terms went into your pocket, but it did drive inflation regardless what they did. So you've had a bit of a bump here. In fact, you took out the 1880, which is a relative high. So for us, that has spoiled the pattern for it being a downside, and it makes it a possible upside break. But we're not over convinced by this bull. We think this is central bank buying and debt disaccumulation. So central banks buy gold. They don't buy silver. Let me say it again. Central banks buy gold because it's higher value in a smaller space. They don't buy silver typically on any great scale. And we've noticed that this is not an organic trend in gold and silver. In short, if I say goodbye to that gold draw for a while, if you get the gold-silver ratio up, we're actually seeing the gold-silver ratio trend up higher. Now, a proper metals bull market is exactly the opposite. And in fact, we called the beginning of this bull market at the 126, 28, 128. We said that's way too high. We should expect a reversal soon. And we got that. That's on the gold and silver markets over here. High over there. You can see it. And then we got an opportunity in there. You can see there's some TA that we've been doing in there. And that was, let's pull it right the way through. I might need to do a few more days to get it all in. Let's go 3 days, half a week. That was our entry at the 113s on the breakdown of that. After that key reversal, again, you've had a number. This is so important for technicians, guys. Big ass trends end with blow-offs to the upside and capitulations of extreme scale to the downside. What did you get? The events of March 2020 were those book-ending events of final blow-offs and capitulations. Capitulations in the bond markets, blow-off in the gold-silver ratio. If you have a look at this, you can see non-stop gold-silver ratio going up, working its way up. The whole definancialization of precious metals, very successfully done. Yes, there was a corrective period during 2016, for a spell, but this has largely been an upward story with occasional pullbacks, and then there's your blow off that took you through the 128. That is a turning event, and that made us macro precious metal bulls. And then we got our upside HVFs on euro and pound, and we traded those into the highs of 2021, which gave us the $2,000 plus. But since then we've been in a pullback. So it's all been about, will they create a panic and a rush to safety because the debt markets are devaluing? If they cause fear, they can drive money out of risk assets into safe haven, inverted commas, the debt markets again, which will take some of the pressure on the rates. And because you're losing money, because your disposable income is much less because of the inflationary effect, because the oil price is rude high and the Rockefellers are making out like bandits with all their mates, what you will have is this hollowing out of wealth, disposable income in the middle classes right the way through to the blue collar, especially hard on the working classes. So this was a big reversal. But what we're seeing now actually on this has been a working up. And we need this to reverse down for normal conviction in a down side movement for gold and silver, which requires silver to also be respected for its monetary properties. And that is not happening for now. And you can see that this has moved up, not in the most bullish channel range because it is counter trend. But we are arguing as long as this is moving up and in the shorter term, recently moving up. So if we drop back down just to the dailies and the 4 hourlies, what's been happening? You've been broadly moving up. It's a little bit choppy now, but broadly moving up. That means silver is losing ground to gold. That is not typical bull market price behavior performance. Further to that, let's take you into the silver. This is the one we are short and we took short and we're still short. This was a trend. This looked like continuation to the downside. The sell-offs, super hard, bang. Bid absence, bang. A key point where you are attempting to support over here. You can see it. And then despite reasonably strong rallies, you do not sustain above this $23 line for very long. And why are we highlighting the 23 and the 22.5 line? Well, we've done the TA on the lower time frame, so let's just show you what's happened on this particular chart. First of all, what is that? That's volume by price. That shows you where the bulk of the trade is occurring. So if we do a quick $12-hour chart, we drop it down. Where's all the volume happened? Well, the point of control and the highest volume is in and around and below the 22.5 line. So there was a neckline at 23. We were highlighting a little left shoulder, head and right shoulder. You made that target before you pulled back and revisited that neckline on a hammer. And you went marginally higher. You came back down, you threw another neckline down at the 22.5, now lower than the previous one. You tried to make that target and failed. You run the stop of the right shoulder. We weren't trading that, we're observing this. Patterns are failing. Eventually, the support at 22. So you've had 3 successive events of support at the 22. This is just run, and then on the 22. Then you rallied up, again failing at the legacy target of this head and shoulder. So here you had a pattern perform. So this is green for pattern perform. Let's go do it. Jaw. Pattern performance there, from there to a lower one, not performing and getting stopped out. So this is showing less vitality to the upside. And you can see that the general slope with quite a lot of heavy pullbacks, there was again a flag at the 23. 23 is a key level, and then bounce up. A bounce on that interim target that you were supposed to make and only made a lot later after being stopped out. So there's a lack of zip, very harsh selling, and bid absence moment here. That spill is almost worse than that higher up spill, and it's coming right into the 22. You needed a double bottom again on the 23 to get back up to make that 24 target, and then off again. So there's lots of interplay here, and the volume is largely here. The volume is low. It's the heaviest part. So the dark blue and yellow is 70%. So that is 70%. So the sum of that and this is going to be 30%. And this entire box here is the remaining 70, the bulk of which is in this lower zone. So this is telling me heavy protection. We are looking for a trapdoor more than we are taking out a top. Silver is being left behind versus gold. This is not a typical bullish, all the metals properly bid. This is a central banker, government type purchase, hedge fund type purchase, clearing out debt, the yields going up, the values going down, into the likes of potentially Bitcoin, but certainly gold as well, because you're not seeing the same level of takeout of high. So where will we be wrong? Well, this is our assessed second impulse. You can learn all about this why and how we do that, some of the things that I'm just illustrating here for you. But at the point of 24.76, I will say, okay, this is no longer happening. This is no longer happening. It is not coming. We are awaiting a fairly vicious deflationary sell-off, which could be a Fed person's making a statement. It could be any form of the de-escalation of this war narrative, any news given. You can guess at your heart's content. But structurally wise, this chart is seeming to be leaned on across the highs. Across the highs, this red line is illustrating compression, whilst the bottom is fairly flat. So that is why we are bearish silver, and why we thought that might be an early third. Your safe stop is always your stop at the secondary high. It went a little higher, and then came and took out. So your high risk trades where you were selling that short would have been stopped out on there. Your lower risk ones with lower sizing, remember that, are still in. And in fact, I added a little bit on this sell-off. So that's where we are on silver. Silver is our trade. Gold was never our trade, but gold is the God market, and contrasting gold versus silver is of interest and value to us. Some might ask, what about the other precious metals? There are, of course, many, such as platinum, palladium, and copper, which is significantly more industrial, but is considered also somewhat semi-precious, particularly in China. And palladium's had a nice little run break there, but it has been a super volatile, and it was deeply underbid for a lengthy period after a huge run. It was one of the earliest and had an epic run. So let's just remind everyone of that. You might think that's bullish, but it also has a threat of a very strong right shoulder after a very strong left shoulder as well. So if there was deflation, there could be a scenario where it goes both down and up. It's not a clear signal, but to remind everyone, palladium was one of the most powerful markets. You could have got it at 454. If we go monthly, you'll see that in actual fact, right down at the lows of 2008, you could have got it for $159, now $2,274. This volatility, though, is of concern. And it wouldn't be a shock to me to look back at this chart in a year or two's time and see that as a localized top, at least for some period. It wouldn't shock me, in spite of that zippiness that you've just seen over there. There is a lot of sketchiness in the palladium chart. So I wouldn't get overtly excessively bullish. I have made a case for platinum on account of its falling wedge, but again, a bit of industrial use comes in for platinum. We should see, to be really runaway bulls in precious metals, we should see a far broader support. This was a breakout, and we highlighted that. And you squeezed into a wedge again and had a breakout, and again no follow through over there, and you dipped down again. So we can show you both those events. Here's your macro falling wedge. So there's been quite a lot of false dawning, if that's such a phrase. He's been false dawning on me. So that kind of was, again, us picking very trim, slim wedge structures that should get a breakout. They got a breakout and then traded lower after going higher. So disappointing. This currently looks a little bit uppity, but we need to see what's happening. I think there's just a bit of a bid under the debt markets. What happens if there's a fear trade and money runs back into the debt market? I think a lot of this enthusiasm for the precious metals could be taken away before we then get our macro bull. What about copper? Copper has the same concerning, whilst generally looking like it's been building a continuation pattern. It does also have just a bit of a worrying grind along there. If gold resolves and goes significantly higher and drags silver along with it, then this will be a runner to the upside. However, if we get that deflationary event and gold sells off, through what we call a basing ascending grind line, then you're probably lower. So that's a bit of an update on the copper side. This can go either way. Doesn't look too bad for the bullish side. Just these are very narrow spike ups that get punished very hard down. Some proper selling. There's some softness also. The Chinese element on this is very much a building metal. A lot of copper required in there. So that's a little bit of what we've spoken about on debt markets, the relationship to precious metals. Will we be right or wrong? We could well be wrong on this one, guys. We said all along we can be wrong on this tactical element. We are macro bulls. But could there be one more dip? Was our thesis. That is still not ready. This is an inverted chart of ARK. So this is tech stocks. Now I'm going to put it on the right way around because some of you are going to battle to perceive this. But this upward move is actually a bearish move. There was an HVF. You could have bought puts. This would have been good money for you. And she's heavily into the high beta tech stocks. Let's have a look at ARK on this. So we're pivoting now to a tech stock with high beta, a tech investment fund, I should say. That has been very topical and interesting for some time. So the normal way around, we've called a couple of times grind lines to be broken with inverted structures, target made, and then a new one set up, broke, a new one set up there, broke, and now you're in this structure over here. I don't know about you, but highly speculative tech stocks, in spite of them being a whole bunch cheaper than they were from that previous high at 160, are not the right flavor. I'm still shocked they pushed this so high for so long. With what we already knew about debt in March of 2021. That was a full year after what I considered to be a debt reversal event. Without a doubt. And here's the inflation. And it's going to get worse. Inflation keeps coming at you. It feeds on itself because people start behaving differently. They rush to buy things and they hoard. So they further exacerbate the issue. When, you know, there's no point in postponing. It's only more expensive later. The value of money is dying. You're watching it more real. And by the way, John Williams Shadow Stats, you're probably between 15 and 16% in truth. So on a bent measure that has been adjusted, for which there's all forms of shrinkflation, trickery that goes into the number, you are facing much higher inflation than you realize. You should probably be at the interest rates that Volcker took you at the peak in the 80s. That's right. That's 15, 16%, because then you might be paying close to a positive return. Everything is posting a guaranteed negative yield, a substantially negative yield. So what do you think of this? Well, I think in time it rolls over lower. I think we're not done. And in that event, by the way, I'm not alone on that one. Let's just bring in our friends at Zero Hedge with their market ear. It's a premium product, so go and check them out. Buy it if you want it. Market ear. It doesn't cost an absolute fortune. It's potentially worth having a look at. Let's look at that chart a little bit. This is ARK. I mean, these charts always are a little bit deceptive. They always look very, very similar. You know, something that goes up, has a parabolic moment, has its first slap in the face, as we like to call it. And that is often the warning. And that's where you often get inverted HVFs for the downside move, which we've highlighted there. The NASDAQ between 98 and 2003 did very much that same curve. So according to their analysis as well, you could be getting a continuation pattern that will then have another leg to the downside. This overall as leg 3 appears to be the largest. So it's typical. Ellioticians will love that. A little bit of an AB, do the B's Egyptian style. There's your C's. And then your D, we go stick with our Egyptian styling, and there you go. You get your first rally, which is your inverted HVF, essentially that structure, and then you get another smaller one, and you get a wave 5. The biggest, normally by 61.8, is the CD leg, the third leg in a 5-way down. That doesn't mean you go complete bull, but you get a bit of a rally, and then you can still peter out and go marginally lower, but that just goes into a longer cycle basing. So that there could be a fifth leg downside trade for puts on ARK, if what we think will happen will happen. And with that level of pressure on tech, even though we expect crypto to outperform against tech now in terms of our Bitcoin Nasdaq that we've shared, it could still be going down, just at a slower rate. So this is the concern. This is obviously one of the highest beta, lots of super speculative, fluffy, new world exponential metaverse plays that will, like Amazon was in its early years. It was a real great stock, but it was also surrounded by pet.com and bridal.com and all those others. So there's a lot of fluffiness, a lot of horses that will not make the race in the long term. So yeah, that was a little bit from our friends at Zero Hedge in terms of that. Was there anything else interesting? Euroland, sclerotic on their equities, by the way, their 50 biggest equities. So you're getting very much a broadening structure and quite high VIX. This is not bullish. This is not bullish. So they are not getting too much love on the bid. Don't forget, bearish the euro as a currency as well, or euro Swiss franc. Turned back down. Some people said, what happened to your euro Swiss franc? The euro Swiss franc is fine. Quick update on that. I never mentioned it, but I'm going to do one. Quick update on that. Euro Swiss franc, this is when you should have been short. Up top here on the takeout there. For the larger scenario, this is the risk reward, and you've been in. Yes, it got kind of spiky. Yes, the euro had an up leg, but this sell off back down to the 1.05 is typical because you ran the last low to get some degree of price behavior reaction following running as one of the secular lows of 14th May 2020. That was post COVID event. It's absolutely natural that once you spilled there, in fact, it's made a neckline on a bit of a W bottom there, and so you bumped up and that. So it's thrown you off the scent. This is a big time frame setup, guys. This is a monthly chart. If people are going to ask every time they have a couple of days in a row that goes against them, what happened to my trade? Listen, first of all, own your own outcomes. Second of all, anything can and probably will happen. And third of all, you've got to be patient if you're trading this time frame. This is, and bear in mind cost as well. So, you know, if you have a ridiculously expensive spread beta, you might not hold it. But when the capitulation stage happens, and you will learn about 5 stages in a breakdown or a breakup in our content on themarketsniper.com, there is a capitulation or a melt up stage. That is typically stage 3. And in that event, that is where you make all your money. The money's not made in the run from 108 to where it is now at 104, albeit 450 odd points. The money's made in the absolute spiller there. This skidding into a low stage, this had quite a lot of very juicy parts because it was pretty consistent. But as you can see, those are the moves that make you the money. Those are the moves that make you the money. Even these trending downs. But you ran a secular low that had only been superseded by the major event of 6 years ago. Now going on 7 years ago there. So that is your last secular low. You ran it. Of course, you get a little bit of a reaction. Let's take our eyeball off a little bit so that you can see just the candles. That scared you out with that wick and selling back down, then you shouldn't be in trading, or you shouldn't be trading on this time frame. And by the way, the macro time frames are your best time frames. So again, just to summarize, that is your squeeze, and it actually incorporates this false market event. There was a box put under there by the Swiss National Bank, although the wife of the SNB was quite happy to be trading FX. I would suggest maybe it wasn't her, although her name was being used. So that is actually the continuation pattern you are trading. But in terms of how the market put a box under it until it eventually collapsed, this is what you're trading. So you're trading a breakdown in the Eurozone. Don't forget, it's also signaled in the Euro USD. So you're American, you want to know about the dollar. It's going to be one of the better currencies in our view. This debt devaluation is not going to be kind to most Forex, particularly those that owe dollars. So if you have a look at the Euro USD, quick reminder, in our opinion, you are facing a head and shoulders. Go 2-day, reframe that quickly. Put the eye back on, and that is our scenario. So right now, a lot of people get thrown off the scent because it stopped throwing money at you. You have essentially, we warned that this would likely be a right shoulder. You could have been in at 118. You've had money thrown at you virtually non-stop, but for a wick revisit, which is absolutely typical of head and shoulder theory, to our chosen neckline. We only use, you can learn all about complex head and shoulders and how we do them practically that works in real markets. Marketsniper.com, book a call. Rejection. Down, 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 down. So now you've had such a good spell. You've run to 111 from the 118s. Of course, you're getting now a bit of churn, a little bit of a pop out the top, smash back down, spike rally, selling off. So it's churning a little bit. It will trade through there on balance of probabilities in our opinion, and that risk reward, by the way, of 13.69 will be home. So that's a little bit on the Euro USD for you. Okay, so we've given you a lot today. We've done an update on the gold and silver. The silver is still in play. Our concern for the bull market is the gold and silver ratio is not walking the talk. This is looking more like gold bid out of an exit out of debt. We've updated you on the debt markets and the significance of this. Go watch that legacy video. It's not too long, which we did on debt, suggesting all the way back when the pandemic occurred, why it was the key turning event. We've highlighted and updated you on the role of the dollar, the Euro USD. Probably the only of the majors that we haven't referred to was the Dixie, which I will just show, very similar to the Euro USD as well, that we continue to be bullish on, but right now is not particularly special. And again, remember that this, in our opinion, is a continuation structure, but it has reached a level where it may just go grindy higher and have a bit of a pullback period. This was our guess for roundabout here. So it might be here, start already. It might still go a little bit higher and start, but it will break out to the upside on balance of probabilities in our opinion. Okay. Well done for watching and getting through all of that. Don't forget, you can follow the Crypto Sniper, the Market Sniper. Massive announcement. We will do, anyone joining a Trading Metamorphosis program over the course of the next few weeks will get a physical event as part of your advanced training here in Panama, where we'll be putting it on. It'll be around about mid-March. We have the dates. We are notifying all our premium community. They will be there. There will be other members physically present for that. If you were on board, you would also need to have got through the basic material and the intermediate material, all beautifully recorded in our LearnDash environment. That's a custom learning environment with great quality videos, neatly done, PowerPoint, best audio, and a recording studio environment. So you will get that benefit of a physical event as well. We don't do these anymore. We haven't done them in ages because of, all the reasons why. And we've put everything online to a very high standard. But whenever we can, we love to meet our community members. And you can also undertake reset preparations as well that many of our community members have undertaken in this particular locale, and meet the partners that will be executing on your behalf if you are physically present. Plus, you can sit, we'll have meals, we'll have some drinks on the first day. Second day, we will do pop out to the restaurant. It'll be a nice social affair. You can meet other like-minded community members in person. You can talk normally. Instead of a normie filter for those that have all been consuming the MSM. Plus, talk about your trading and everything else you're doing. Very, very exciting. Looking forward to that one coming mid-March. Only for Trading Metamorphosis Program subscribers. If you can't make Panama, it will still be streamed to you directly on a link so that you can watch it, and it will also be recorded for premium community members. That is the Trading Metamorphosis guys. So we hope to see some of you there. Email support at the Market Sniper if you want to know more about that as well. But you'll first need to be a TMP member. So book a call, www.themarketsniper. Thanks for checking in with me on all the markets. We will see more, but we continue to say dollar higher. Yes, it can do a down leg. Certainly even right down to here, but in the longer run, dollar higher. This debt problem is going to hurt everybody. It's going to be made your problem. People don't realize how big this is, and America will, as a currency, will do better out of it, as they have the unique advantage of being the global currency reserve of store. Long run, we still see metals higher, though, once this particular area resolves. We will see. Will it be deflation? I'm asking you. Will we get a deflationary strike? Are we going to get a warning as that rate hike comes closer? In fact, you could be at the event just after it's occurred. Or will it be everything groovy, Bitcoin up, gold and silver up, and all the risk on and anti-fiats flying? Your opinion is interesting. We love to hear it. Put it in the comments below. Share and like, and I will catch you next time. Thank you very much for watching.